Greetings, and welcome to PLBY Group's first quarter 2023 earnings conference call and webcast. At this time, all participants are in a listen-only mode. A question-and-answer session will follow the formal presentation. If anyone should require operator assistance during the conference, please press star zero on your telephone keypad. As a reminder, this conference is being recorded. It is now my pleasure to introduce your host, Ashley DeSimone with ICR. Thank you. You may begin.
Good afternoon, everyone, and welcome to PLBY Group's first quarter 2023 earnings conference call. I'm Ashley DeSimone from ICR. Hosting today's call are Ben Cohn, Chief Executive Officer, and Mark Crossman, Chief Financial Officer and Chief Operating Officer. The information discussed today is qualified in its entirety by the Form 8-K that has been filed by PLBY Group, Inc., which may be accessed on the SEC's website and PLBY Group's website. Today's call is also being webcast, and a replay will be posted to PLBY Group's investor relations website. Please note that statements made during this call, including financial projections or other statements that are not historical in nature, may constitute forward-looking statements. Such statements are made on the basis of PLBY Group's views and assumptions regarding future events and business performance at the time they're made, and we do not undertake any obligation to update these statements. Forward-looking statements are subject to risks which could cause PLBY Group's actual results to differ from its historical results and forecasts, including those risks set forth in PLBY Group's filings with the SEC, and you should refer to and carefully consider those for more information. This cautionary statement applies to all forward-looking statements made during this call. Do not place undue reliance on any forward-looking statement. During this call, PLBY Group will be referring to non-GAAP financial measures. These non-GAAP measures are not prepared in accordance with generally accepted accounting principles. A reconciliation of the non-GAAP financial measures to the most directly comparable GAAP measures is available in the earnings release PLBY Group filed with its Form 8-K today. I will now open the call to Ben Cohn. Ben, please go ahead.
Thank you, Ashley, and good afternoon, everyone. Before we get started, I would like to introduce Mark Crossman, our new Chief Operating Officer and Chief Financial Officer, who joined us just about a month ago. Mark brings a wealth of operating experience, both in consumer products and the technology sectors, to the team. As you will hear in a few minutes, Mark is in the beginning stages of helping me rebuild our cost infrastructure and has already identified millions of dollars of cost reductions not previously identified that we will be going after in the coming months. With Mark now on the team, I have reorganized our management team. Mark will be taking over consumer products in addition to his CFO responsibilities, and I will be focusing on our creator platform and licensing. I am pleased to report that in Q1, GMV on our creator platform increased 2.4 times over Q4, and since our last earnings call on March 16th, our weekly GMV as of last week has increased a further 70%. We have also made significant progress transitioning the business to a capital-light model. This afternoon, I'm going to share updates in three key areas. First, I'm going to dive into more detail on the growth of our creator platform and why we're so excited about the momentum we're seeing. Second, I'll share an update on the work we've done to improve the long-term economics of our JV in China, as well as other updates on our licensing business. And third, I'll expand on the progress we've made streamlining our operating model and reducing both our operating expenses and our gross debt. Mark will then walk you through some updates on Lovers and Honey Birdette and provide you with more detailed financial information. First, on our creator platform. As shared at the start, Q1 was up 2.4 times, and we have grown an additional 70% since our last earnings call. Our weekly growth rate year to date has remained above 10%, so we're really excited about the growth in revenue that our creators continue to generate on the platform. As of last week, we now have approximately 2,200 monthly earning creators and approximately 1.9 million registered users, which means that our creator and fan bases are not only growing, but also individually spending and earning more than they were last quarter. And lastly, as we're scaling, we're seeing economies of scale with our cost structure, and we're continuing to renegotiate more favorable terms with our key vendors. For example, we just added a new payment processing partner that lowers our fees by approximately 50%. Since we last spoke, our product engineering and design teams have remained focused on continuously improving the creator and fan experiences. On the creator monetization side, we have significantly improved our onboarding flows to support creators in earning their first dollars more quickly. We've continued to iterate on our profile design to drive more creator-fan conversations and engagement, which leads to greater monetization, and we've rolled out the ability to offer bundled subscription offers, promotional discounts, and more. We've also been focused on ensuring a differentiated product experience from our competitors in the space. Playboy has a history of unprecedented ability to mint new stars, and our creator platform is no different. Creator discovery and promotion is an area we believe we can win in. Since we last spoke, we've introduced a centerfold of the day section, a new UI that enables searching by categories of creators, as well as interest tags that creators can label themselves with for further exposure. We hear from creators every day how proud they are to be on Playboy, and we're dedicated to helping them be discovered and make more money than they can make on other competitive platforms. Today, creators earn income on our platform in 4 key ways. Roughly 60% of creator revenue is generated via messaging, whereby fans engage with creators in ways they cannot on other platforms and purchase content the creators send them in direct messages. Roughly 15% is generated via monthly subscriptions, and another 15% is generated via content unlocked directly on the wall of a creator's profile. And lastly, roughly 10% is generated via tips. At this stage, we split GMV 80% to the creator and 20% to Playboy. In addition to the continuous work we're doing to improve creator monetization, we also intend to soon roll out value-added features and offerings that allow us to increase our percentage of those economics. You can imagine advanced features or special access, such as the ability for a fan to show up at the top of a creator's inbox, or exclusive access to extended Playboy photo shoots, archival Playmate galleries, or one of our iconic Playboy parties all over the world as perks that would become part of a Playboy membership proposition that sits on top of individual creator monetization. We are still in the early stages of developing this membership value proposition and its potential tiers, but our goal is to ensure that as we scale our platform, we can meaningfully expand its profitability with services that have more favorable economics to Playboy. I am very encouraged by the momentum to date with our creator platform and look forward to keeping you up to speed on our progress. Next, I am pleased to report that since we last spoke in March, we successfully negotiated amendments over a number of our licensing agreements as part of our recently formed China joint venture. The goal of these renegotiations was to both support our existing licensees, whose businesses were significantly impacted by the COVID shutdowns from last year, while also establishing new, more favorable foundation agreement terms to drive a more diversified and sustainable business within our China joint venture going forward. While the revised agreements call for lower minimum guarantees, in exchange, we have removed exclusivity clauses, added stronger audit controls and visibility to sales data, taken back product categories, significantly increased our royalty or percentage of sales, and are working on transferring the ownership of the partner's e-commerce stores to the Playboy China joint venture. One thing to note is that during the first quarter, we did not book any revenue related to one of these licensees, as we are in the process of negotiating a revised agreement. We have now signed an agreement with that partner and are now working on collecting those royalties. We have also made significant progress with Douyin, the TikTok of China, to establish a flagship e-commerce store that our Playboy China joint venture is expected to own. Douyin is now one of the largest e-commerce engines in China, and Playboy had previously been blocked on Douyin based on our legacy licensing model. Our JV with the Fun Group and a revised contract with our licensees solves this issue. Moving forward, to solve the Douyin issue, we anticipate that our licensing partners will sell through the Playboy China joint venture Douyin store, which will help us more effectively control the Playboy brand positioning, pricing, product design and marketing, and collect cash while our licensing partners operate manufacturing, fulfillment, and product inventory. All of this is part of our larger strategy to diversify our revenue across partners and businesses in China while having increased visibility into direct sales and more directly controlling the consumer-facing components of the brand. Last quarter, we set forth our intention to transform our U.S. Playboy D2C business to a licensing model. We have now signed a binding term sheet with a non-affiliated partner who brings a wealth of experience and proven track record of success in developing and executing effective e-commerce strategies and brand development. This partner was instrumental in launching several of Playboy's hugely popular collaborations with streetwear brands including Fragment, Antisocial Social Club, and Revenge. Their passion for our brand and understanding of today's customers are unparalleled. This transition is underway with the deal expected to close by June 1st, and we are excited for the next chapter of the Playboy shop and its enormous potential for innovation, including the integration with our creator platform and community experiences that only Playboy can provide. Moving forward, our partner will take over all costs and operations of our shop, and we will receive 15% of net revenue. We remain optimistic about the continued demand for the Playboy brand and unlocking its power across new categories and territories around the world. Our new sexual wellness licensee surpassed $1 million in total sales since launching in our Lover stores and are now rolling out to third-party retailers. We signed an amendment in Q1 to accelerate growth in LATAM, UK, and Europe. In Q1, our team closed a total of 15 new licensing agreements, of which 13 were international, across fashion collaborations as well as new men's grooming and home decor categories. Lastly, I'm happy to report on the progress we've made transitioning the business to a capital-light model, reducing our operating expenses and reducing our gross debt. With the momentum we're experiencing with our creator platform and the high margin revenue we see from licensing, we have decided to fully exit serving as the operator of our consumer product businesses. This means that in addition to selling Yandy, which we previously reported, we will now be taking 3 additional steps. First, as we just mentioned, we recently signed a binding term sheet to license our Playboy D2C business. Second, we've engaged Sage Group to explore all strategic alternatives for Lovers. And third, we've engaged Moelis & Company to explore all strategic alternatives for Honey Birdette. Because of this decision to fully exit the operations of D2C and retail consumer products, we've recently eliminated $3 million of personnel costs. As we continue to execute the remaining steps, we anticipate meaningful additional cost savings. We expect this decision to be net neutral to profitable to Playboy, given that the additional cost savings are expected to more than offset any loss in contribution margin from these businesses. We also expect that our free cash flow should be higher as we won't have inventory or the CapEx related to store maintenance and openings. Lastly, I want to share some positive news on a debt restructure and refinancing we just completed. Specifically, we were able to negotiate the assignment of approximately $91 million of our senior debt from certain of our lenders to a primary lender at 87.25 cents on the dollar, resulting in a discount of approximately $12 million. We also negotiated the exchange of our preferred stock, which is held by one of our lenders, for additional principal of our senior debt at a $7 million discount to the current liquidation value. In order to accommodate the restructuring of our senior debt and preferred stock, we amended and restated our senior debt agreement with Fortress and our other lenders. The restated facility actually lowers our total cost of capital by lowering the interest rate so that in total our cash interest costs remain substantially the same while eliminating the accrual and payment in kind features of the preferred stock. Fortress has also made available to us the $12 million discount obtained from the other lenders as new cash on our balance sheet. In total, we will have $210 million of gross debt outstanding, down from our $216 before, inclusive of the preferred stock. But we now have an additional $12 million of cash on our balance sheet, bringing total cash to an excess of $35 million. The bulk of the restated facility has no amortization payments, thus saving the company over $2 million of cash during such period, and has no leverage covenants until Q1 2025. The restated facility had no fees associated with it and has no prepayment penalty. We can elect at our option to prepay it at any time. Our intention is to prepay for that facility as soon as we can. To the extent possible, we would like to use the proceeds from the asset divestitures we discussed, as well as the proceeds we hope to generate from selling our art collection, a process we have recently kicked off, to pay down debt. Before handing the call over to Mark, I want to conclude by saying how excited I am by the momentum of our creator platform and our singular focus on the Playboy brand. With that, I'll hand the call over to Mark.
Thank you, Ben, and hello, everyone. Since joining as CFO and COO, I've been working closely with Ben to rebuild our cost structure and fully move the company towards a capital-light model. As a part of this process, we are aggressively reducing costs not needed to support our two business lines moving forward, the creator platform and licensing. These two businesses have greater potential for growth, higher margins, and lower working capital requirements. Before I get into the financials, I want to share with you a few of the initiatives we're taking at both Lovers and Honey Birdette. At Lovers, our store traffic is down commensurate with the industry, and in the absence of deploying significant sums of money to marketing, we're focusing on lifting our margins and diversifying our product assortment to give us the flexibility to run promotions in line with our competitors. Regarding margins, we are leaning into our Playboy Pleasures line of sex toys, a licensed product. Playboy Pleasures just crossed $1 million in sales and carries roughly 25 points higher gross margins versus our average gross margin and has only been in stores for a couple of months. We have a new Playboy Pleasures assortment landing in Q2 and are developing another special line for later this year. In the last month of the quarter, we saw an improvement in conversion and average transaction value, and starting in June, we plan to bring our promotional efforts in line with our competitors to accelerate our revenue growth. Turning to Honey Birdette, our sales were down year over year for three primary reasons. First, as we previously discussed, we did not run our March promotional event this year. Second, the particularly difficult macro environment in Australia. And third, switching our digital advertising agency, which impacted our online sales, or about half of our sales. While we can't impact the macro environment in Australia, we are planning on running our June sale 1 week earlier to capture Memorial Day weekend sales. In addition, we plan to ramp up our digital advertising spend in the back half of the quarter with our new agency, as they were able to get Meta to unblock our advertising and have seen our blended ROAS return to normal. By way of background, Meta had blocked our advertising in the first quarter because they deemed it to be sexually explicit material. As a result, our blended return on advertising spending dropped from 18 times to 13 times over the year. We're also making a couple of additional changes to the business. We're going to reduce our SKU count starting in the fourth quarter of this year. It will allow us to make smaller inventory buys per collection without sacrificing the depth of our size scale. The result should increase our inventory turnover and free up working capital without reducing the number of new collections we launch per year. We are also aggressively cutting our supply chain costs. We found inefficiencies in all areas of our shipping and logistics. Given the strategic alternatives we're exploring, we're going to pause on opening new stores. We remain very excited about the brand's position in the market and its long-term growth potential. Turning to Q1 results, we finished the quarter with net revenues of $51.4 million. Our direct-to-consumer business was down $12.7 million, or 25%. I want to point out that revenues from our Yandy and Playboy.com businesses were down $4.9 million. However, Yandy was just sold after the end of the quarter, and we recently signed a binding LOI to license Playboy.com. Accordingly, after the second quarter, we won't recognize revenue from Yandy and will only recognize licensing income from Playboy.com, which will be reflected in our licensing segment. Revenues from the remainder of our direct-to-consumer segment were down $7.8 million. The majority of the decline was attributable to reduced traffic, both in-store and online. During the quarter, we were not as promotional and allocated fewer dollars to paid marketing in both our Lovers and Honey Birdette businesses. Furthermore, as we previously communicated, we chose to forego a sale in March at Honey Birdette as compared to a year ago. Not running the March sale at Honey Birdette alone resulted in a reduction of $2 million of sales in the quarter. From our vantage point, it is clear that economic conditions are weighing on our consumer both domestically and abroad, and sales and promotions are increasingly driving the purchase-making decision. Licensing revenue decreased by $5 million versus the prior year period. While there is no doubt weaker consumer demand experienced by our licensing partners in China and the U.S. was a challenge, the vast majority of the decline was attributable to the timing of $3 million of cash receipts from one of our largest licensees in China. We book revenue from that licensee on a cash collected basis. However, as Ben mentioned, we recently agreed to a revised deal with that partner and expect to collect the past due cash this quarter. Revenue in our digital subscriptions and content segment was essentially flat. The growth we are seeing from our creator platform, 2.5 times in Q1 GMV versus Q4, is offsetting the secular declines in linear television. With the gains being made by our creator platform, we should anticipate seeing this segment growing on a consolidated basis in the near future. Adjusted EBITDA was a loss of $10.8 million. However, $1.7 million of the losses were attributable to Yandy, $2.6 million of the losses were attributable to Playboy.com, and $2.4 million of the losses were related to reserve against slow-moving Honey Birdette inventory. Excluding those items, adjusted EBITDA would have been a loss of $4.1 million, and if the China revenue had come in on time, adjusted EBITDA would have been close to break even. It is also worth noting that the cost cuts we made in March are largely not reflected in our first quarter adjusted EBITDA results, which for the quarter would have been approximately $2 million. This number is only for the actual cuts made in March and not those previously identified to be made in the future. Since March, we have cut approximately $3 million of additional annualized headcount, and after a continued review of the various business lines and operating processes, we have identified additional cost savings through reprioritizing our spend on critical technology and reconfiguring our supply chain economics. Our goal is to simplify our technology stack and cut our supply chain costs while doing so with a leaner organization. We believe we can reduce our expenses by another $7 million on a run rate basis after the transition costs will occur over the next couple of quarters. I want to reiterate that the cost savings related to technology, supply chain, and inventory will take a couple of quarters to show up in our P&L. While we are not providing revenue and EBITDA guidance at this time, we plan to resume issuing guidance after we have finished implementing our operational changes and made further progress on our transition to a capital-light business model. To be clear, the capital-light business model to which we are transitioning has the same capacity for EBITDA generation and better revenue growth prospects, albeit with relatively small CapEx and working capital needs. Before I open the line for questions, I want to reiterate that given the cash on the balance sheet post-debt restructuring and the changes we are making to the business, we have more than ample liquidity moving forward. With that, I'll ask the operator to please open the line for questions.
Thank you. Ladies and gentlemen, at this time, we'll be conducting a question-and-answer session. If you'd like to ask a question, you may press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star key. In the interest of time, if you could please limit yourself to one question and one follow-up, and then re-queue up for more questions if you have some. Our first question comes from the line of Jason Tilchen with Canaccord. Please proceed with your question.
Great. Thanks for taking the question. I guess on the creator platform, could you just maybe talk a little bit about how your revenue share compares to other platforms in the space, and if you see an opportunity to potentially give back a little more of the economics, at least as you're ramping the platform to attract more creators? Thanks.
Thanks, Jason. It's Ben Cohen. Our revenue percentage as a percentage of the GMV or the total creator revenue is exactly the same as the other major platforms out there. I actually look at it differently. I don't see any need to cut that percentage at all. As we said on the last earnings call, our goal was to get to 10,000 creators by year end. We've grown from 1,500 to 2,200. And if you actually ran the math on a daily basis, just assuming averages to the end of the year, you're only talking about 35 creators a day. What we actually see is, the creators sitting at the nucleus or the center of that universe. These core services that we provide today are that 20% bucket. So, tipping, messaging, and subscription. we actually see a second layer of services that would be value-added services that could leverage AI or other things that would actually allow us to charge more or increase our percentage of revenue. And then on top of all of that, long-term, we see a membership opportunity which would even be a higher percentage of revenue. I want to be clear, though, in the short term, we are focused on one thing only, which is adding more creators and adding more users.
Great, thanks. That's really helpful. And just a quick follow-up to that. Previously, when you had the Playboy.com e-commerce platform as part of the strategy, there was sort of an idea of having a flywheel effect where you would have the creators promoting some of the products. How can you, in this new licensing model, still sort of leverage the creators to create exclusive collections or to promote the existing merchandise?
Yeah, so long-term, nothing has changed from that. It's a licensing model, but with a partner we've done a lot of work with in the past, as we mentioned, Antisocial Social, et cetera. And so that is part of our deal moving forward with them, which is leveraging our creators to become affiliates, as well as developing select or special merchandise based on various events. So, whether that be a Playboy Super Bowl party or something tied specifically to a creator or apparel that would only be available to our members, that is all part of the deal we have negotiated with that partner.
Great. Thank you.
Our next question comes from the line of Alex Furman with Craig-Hallum. Please proceed with your question.
Great. Thanks very much for taking my question. It sounds like the creator platform is scaling very nicely. What are some, you mentioned other geographies that you could potentially take that to, when might that start to happen, and any update you can give us on your plans for the platform as you think about next year? I know it sounds like you're focused primarily on getting creators. When will we start to see some more significant leverage on the bottom line there?
Thanks, Alex. I'm a little bit confused on the additional geographies. The platform is open to almost every geography, obviously China not being part of that, given the restrictions on social media and technology. But we have creators from all over the world for the most part on the platform today. When you actually look at sort of the geographic distribution of creators, about 67% of those, 68% of those come from North America. So that is our single largest. But we have creators from almost everywhere in the world. When we think about guidance that we've given or what we said in the last earnings call, we've continued to exceed our internal budgets since we last spoke. And what we talked about was the creator platform being break even to cash flow positive for the year. We did mention in the call that we've reduced our payment processing. We've added a new payment processor, which reduces our fees by about 50%. Our fixed costs aren't changing that much. And so, when you look at the end of the year, and without getting into specifics, what you end the year with as you get to that break-even to cash flow positive number is obviously on a run rate basis much larger moving into next year. If you did annualize right now our weekly GMV, and you did assumed zero growth going forward, and we're growing at north of a 10% weekly CAGR right now, that number would be in excess of $25 million, and that's up from the $15 million on our last earnings call.
Okay, that's really helpful, Ben. Yeah, I must have misheard you about the international component there. Thank you very much.
Yep.
Our next question comes from the line of Jim Duffy with Stifel. Please proceed with your question.
Well, good afternoon. Hi, Ben. Hi, Mark. Mark, nice to make your acquaintance. Ben, I'm going to send this one your way. It sounds like a lot of hard work realigning the business model. You gave some great detail on what changes, what's no longer part of the go-forward strategy. Let's just take a high-level view. Can I ask you to detail what's left? Simplistically, what's the team of businesses you'll have on the field at the end of it all? What's the game you think you can win? And if you execute to the game plan, what do equity investors win? Paint us a picture of a shiny trophy.
Sure. Well, let me just paint you a realistic picture of what will be left. What's left is Playboy, and we're leaning into that billion-dollar brand of Playboy. And specifically, our creator platform will be our hero product. The growth we're seeing with that warrants that, and licensing providing high margin cash flow to support that. That's what's left. And what we look at, from a organization is a much simpler organization. And in fact, when you look at sort of a working capital situation as well, you're almost in a negative working capital situation based on how the cash flows in that business work.
Okay. Mark, I wanted to ask on Honey Birdette. This was, at the time of acquisition, mid-high 30s EBITDA margin business with an eye towards, what you might be able to realize in strategic alternatives. Where are those margins now? And what do you think is realistic for margin structure for that business?
Yeah, pleasure to meet you, Jim. The margins right now, what we're seeing is they're a little bit below where they've been historically. And a lot of that has been, due to the macro environment in Australia and what I outlined. But I think going forward, we can get back to those numbers. And I don't think, while we can't control the macro environment, we can control our internal costs. And I think that's where you're going to see a lot of the upside, because everything I talked about in terms of SaaS changes and supply chain, and then ultimately getting into sourcing, all of that's coming at the, to the benefit of Honey Birdette.
Okay. Do I re-queue, or do you have time for another?
We have time for another one from you.
Okay, great. You mentioned the new payment processor lowers fees by 50%. What are the payment processing rates? Are you have you been able to get that to the single digits with this new payment processor?
We have. Yeah.
Okay.
So, historically, I think, and I won't speak to ours specifically, but I would say that, in general, when you sometimes are dealing with not safe for work content, you're 10% to 12%, and we've been able to reduce those fees, as we said, by approximately 50%. And so when you look, long term, that is a significant margin improvement long term. And there are things that we're doing to improve that even further, down the road through content moderation and bifurcating content potentially between safe for work and not safe for work.
Helpful. I'll leave it at that. Thank you.
Thanks, Jim.
Our next question comes from the line of George Kelly with Roth Capital Partners. Please proceed with your question.
Hey, everybody. Thanks for taking my questions. So first one, curious if you could talk about your expectations, and I may have missed this in your remarks, but your expectation for Honey Birdette revenue this year. I think it was just over $80 million last year. Just curious what kind of growth you're planning on this year.
Yeah, I think right now, given the transition we're making, we're not giving guidance. But, as I said earlier in my comments, we are seeing a pretty tough macro environment, and particularly in Australia, where it's underperforming the U.S. by about 2 times. So I'd leave it at that until we start giving guidance again.
Okay. And then second question from me is, in your prepared remarks, you talked about the new Chinese deals and how they carry lower guarantees. So I was just wondering if you could quantify that at all. You've given those kind of 10-year outlooks before where you just add up all the guarantees. Is there any way you can sort of help, not over 10 years, of course, but just over the next couple of years, how much lower your guarantees are now?
Sure. So we have 3 major licensees historically that pretty much accounted for 100% of our China revenue. And what I would say is I don't want to get into the specifics right now, George, because we're still with one of them discussing things. But what we are focused on is diversifying that revenue stream. And so the question is, how do you how do you do that? So we've taken back product categories. We've taken back exclusivity on product categories. We've taken over the e-commerce stores or in the process of transitioning those e-commerce stores. We've actually increased our percentage of sales in those contracts considerably. And so all of that is to build a more diversified China business. It was all part of our plan. And that also plays into Douyin, which has taken a massive share of the China e-commerce market, where historically we have been banned or blocked on Douyin. We now are in the process of opening a flagship e-commerce store where it's our intention that our licensees will sell through us on that. And so, in the future, when we're done with negotiations, we can talk about what it looks like, but we've also signed multiple new licensing deals with new partners in China. And so I just don't have the total MGs in front of us moving forward. But our intention long term is to offset any declines with a much more diversified revenue base.
Okay, thanks.
As a reminder, it is star one to ask a question. No additional questions. I'd like to hand it back to Ben Cohen for closing remarks.
Appreciate everyone taking the time, and we look forward to speaking to you on our next earnings call. Thank you.
Ladies and gentlemen, this does conclude today's teleconference. Thank you for your participation. You may disconnect your lines at this time, and have a wonderful day.
Good afternoon, everyone, and welcome to PLBY Group's second quarter 2023 question and answer session. Hosting today's call are Ben Cohen, Chief Executive Officer, and Mark Crossman, Chief Financial Officer and Chief Operating Officer. To join the queue to ask a question, please press star one on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star two if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. Please ask one question and one follow-up question, and then re-queue for additional questions. While we wait for the queue to fill, we remind everyone that the information discussed today is qualified in its entirety by the Form 8-K that has been filed today by PLBY Group, Inc., which may be accessed on the SEC's website and PLBY Group's website. Today's call is also being webcast, and a replay will be posted on PLBY Group's Investor Relations website. Please note that statements made during this call, including financial projections or other statements that are not historical in nature, may constitute forward-looking statements. Such statements are made on the basis of PLBY Group's views and assumptions regarding future events and business performance at the time they're made, and we do not undertake any obligation to update these statements. Forward-looking statements are subject to risks which could cause PLBY Group's actual results to differ from its historical results and forecasts, including those risks set forth in PLBY Group's filings with the SEC, and you should refer to and carefully consider those for more information. This cautionary statement applies to all forward-looking statements made during this call. Do not place undue reliance on any forward-looking statements. During this call, PLBY Group may refer to non-GAAP financial measures. Such non-GAAP measures are not prepared in accordance with generally accepted accounting principles. A reconciliation of non-GAAP financial measures to the most directly comparable GAAP measures is available in the earnings release PLBY Group filed with its Form 8-K today. Ben, do you have any comments before we take the first question?
Thank you, operator, and good afternoon, everyone. We have changed our earnings call format so starting this quarter, we no longer hold prepared remarks. Instead, we will go right into the Q&A dialogue. We see other companies doing this, and we feel it's a better use of time, and it also leans into an open or more open dialogue instead of taking half a conference call to regurgitate what should be in an earnings release. Also in our release, we will lead with a business update from me, and we anticipate sticking with this format going forward. With that, we'll now begin our Q&A session. Operator?
Thank you. Our first question comes from the line of Andrew Uerkwitz with Jefferies. Please proceed with your question.
Hey, thanks for taking my question, and I appreciate the new format. Just two questions. The first one, I think on the last earnings call you mentioned reviewing the strategic value of Honey Birdette. Could you just give an update on that? It seems like a great asset, but it is facing some macro headwinds according to the press release. So just curious where you stand on that particular asset.
Thanks, Andrew. I'll take that, and Mark, please pipe in. We have limited resources internally, and we have been spending a lot of time focused on selling lovers. That business has now been moved to our discontinued ops in the financial statement. We had multiple offers for that business. We are under exclusivity with a party. At the same time, we are working on putting materials together for Honey Birdette for our financial advisor. And based on market conditions, specifically the M&A market, and when we conclude the lovers process, we will then evaluate the timing to start the Honey Birdette process.
Got it. That's helpful. Thank you. And then switching over to the creator platform, I guess like two half questions here. The first is you made several changes in the quarter that seem to have a very positive outcome. Can you just remind us what your roadmap is on adding features and other updates to the platform? And then secondarily, AI has been all the rage. How are you guys thinking about leveraging AI and maybe discovery and other areas? Thank you.
Sure. Look, we are constantly updating the platform, and we're using data to help us do that. So the biggest change that we undertook during the quarter was actually changing our onboarding process. And there were certain things that the consumer or the user does not see that we had to put in place and expand, for example, our moderation tools, making sure that we create a safe platform, not only for the company, for our creators, but also that complies with our credit card companies. And so historically, we were onboarding creators in a very manual way. People would apply, but the process to actually onboard a creator was all manual. And so we looked at actually some of the dating sites as, how do users onboard there? What are the best ones out there, like Bumble, et cetera? And we completely reworked the back end of the system to put in the right, ID checks with state databases, et cetera, coupled with the right AI tools for moderation, and then rework the whole entire process to onboard creators. And the data for that is extremely encouraging. So if you look at what happened, we increased our creator count at the end of July to almost 4,000, about 1,400 earning creators in July. About 1,400 of those earned for the first time in July. The bulk of that came in the second half, and the trends have continued in August. What this allows us to do is now really focus on platform marketing versus what I would say is individual creator recruitment. And at the same time, when you look at the concentration of where our revenue is coming from and how many creators, what's most encouraging to me is we have decreased the percentage of weekly GMV that our top 10 creators contribute to the platform by over 20%. They've decreased by they've decreased by over half, really, more than half, but it's 20 percentage points they've decreased. And so what that tells me is that our revenue mix is becoming much more diverse, and it speaks to the health of the platform that we have a lot more earning creators. We look to continue that moving forward. Other changes we made, we greatly enhanced and rebuilt our live product. There's a lot more coming with that in the future, including a one-on-one live feature. We also did something that others don't have, which is either an entry fee or a pay per minute. And then we also changed where credit cards are put in the system. And so when does a consumer put a credit card in? We just recently did that a few weeks ago, and we've seen a 3x increase in the number of credit cards that consumers are entering versus before. What's coming up? Lastly, we started to test what I would say is legacy content in the system. So we took 12 former playmates of the company. and we created profiles distinguished from other active creator profiles in the system. This is all part of a much larger play that we'll get into as we go into the fall. How do we integrate the various pieces of this company into one hero product, which is our creator platform, and then really how does that integrate into the Playboy lifestyle? But those are the highlights of the changes. There's a lot more coming, and there's a lot more that was done that users might not see that goes into setting up where we're moving throughout the fall and into next year with the product.
Got it. Thank you. That's very helpful. Thank you, Ben.
Our next question comes from the line of Jason Tilchen with Canaccord Genuity. Please proceed with your question.
Great. Good afternoon. Thanks for taking the question. Going back to the creator platform for a second, could you please remind us, maybe update us on the level of investment in that platform that's being made on sort of a quarterly basis, and how you sort of view a target level of GMV to get that creator platform to sort of break even or so? And then I have a follow-up after that. Thanks.
Yeah, so the level of investment we're seeing in the creator platform right now is mainly coming out of OpEx. So it's roughly in line with where we were last quarter. And what was the second part of your question?
Sort of, if you have like a target level of GMV that you're looking towards as sort of a break-even point before that starts to be a positive contributor towards overall profitability.
Yeah, I think if we continue to run at the rate we're at, we'll be able to get there by year end. But we'd have to see a little bit of growth. I think that number's probably around 50 to 55 million of GMV.
Yeah, so at 50 to 55 million of GMV, the business turns cash flow positive for the year. And, right now we continue to see the growth that we've outlined in the previous calls. So if you annualized our weekly GMV right now, we would be in excess of 35 million. We took a little bit of pause during the second quarter on onboarding creators as we were reworking the process. It just wasn't a good use of human capital. And so the acceleration we saw at the end of July, and that's continued, through August, especially when we look at the number of applications and now really turning to platform marketing, is very encouraging for us moving forward.
It's really helpful. And then just on the 8.5 million of cost savings that you called out in the press release, can you just talk about where those are coming from and sort of the specific level that were already taken out in Q2 versus, sort of the timeline for when the rest of that we should expect to be coming out of the business?
Yeah, so a lot of the costs that we're seeing coming out over the course of, the 8.5 that we announced is, I would say, a mix between headcount and basic operating expense for systems that we're using throughout the company. The original headcount or the original cost cutting that we had talked about in the first quarter, a lot of that was coming out of our IT and our supply chain costs. As I said, that'll play out over the course of the next 2 to 3 quarters.
Yeah, and specifically with the 8.5, that, although we've achieved some of that in the month of July, in the second quarter, there's very little, if any, of that in the second quarter. So, we, as we talked about previously, are rebuilding the business line item by line item. And so a huge example and a big part of that is actually repricing all of our insurance at the company. We've seen multiple millions of dollars of savings just through insurance, and we're in a much better market today than we were 2 years ago as well for insurance.
Great. Really helpful. Thanks a lot.
Just as a reminder, it is star one to ask a question. Our next question comes from the line of Alex Furman with Craig-Hallum. Please proceed with your question.
Hey guys, thanks very much for taking my question. Wondering if you could talk about the outsourcing of the Playboy e-commerce business. Can you give us a sense of how profitable that business has been historically. Are you going to have any ongoing expenses related to that business to offset the 15% licensing fee you're going to receive? And then can you just talk about maybe what your licensee there might be able to do in terms of growing the brand or expanding to new types of items?
Yeah, this is Mark. So we had pretty heavy losses from that business in the past when I came in, and part of it was we wanted to turn those losses to profits. We didn't have the infrastructure in place to make the product ourselves, so we had very low margins on it, sub 50% starting margins. And so we licensed it out, and right now the agreement, we don't have any costs that we have to bear. So that 15% hits pretty much straight to the bottom line. So from our perspective, it'll be profitable day one. And I think his minimum guarantees right now start at about $5 million a year. So that's about $750 to the bottom line to us just in year one. And the overall goal is in the course of the next 3 years to grow that to be a $20 million business, if not more.
Yeah, Alex, it's Ben. I'll just chime in. In the second quarter, we had 7 figures of losses still related to Playboy.com, the e-commerce store. And so if you look at our adjusted EBITDA, when we talk about actually being positive without those losses, because we have now closed that deal and outsourced it, EBITDA would have been positive in the second quarter if it weren't for those losses and some costs related to the China one-time costs related to the China JV. And so, the partner was actually in the office yesterday, very encouraged by their early work and actually some of the collaborations they're working on for Playboy merchandise going forward.
Okay, thank you both. That's very helpful.
Our next question comes from the line of Jim Duffy with Stifel. Please proceed with your question.
Well, thank you. Hi, Ben. Hi, Mark. Hey, guys, typically you followed the 10Q coincidental with earnings. Should we expect that tonight?
Yes, you should. It should be forthcoming.
Okay, great. And then considering your comments, is it fair to say you expect monetization of both Lovers and the art collection before year end?
Hey, Jim, it's Ben. Look, I can't predict, buyers and M&A and sale processes. What I can say to you is we received multiple offers on Lovers. We are under exclusivity with a party. That coupled with where we are, our finance team and accounting team decided that it warranted moving that to discontinued ops. And so when you look at our revenue that we reported, you have to add both discontinued ops and continuing ops together, for an apples to apples for the quarter. As far as the art collection, we are in multiple conversations and down the road with multiple parties on selling it either in one or multiple auctions. Some of those will happen before the end of the year. And, we are going beyond just the art collection. I think there's some stuff from our archives that's very interesting. And then we still have a lot of remnants with, furniture from the mansion, et cetera, that we plan on selling.
Helpful, thanks. And then with respect to Honey Birdette, I'm curious, is the brand growing outside of Australia? And then within Australia, it seems like you're ripping the Band-Aid off of a promotional dependence. How long do you think it could be before that Australia business can rebase?
Yeah, so the Australia business decline is outpacing the decline that we're seeing in the U.S. and Europe. But I, make no bones about it, is the brand is declining in both the U.S. and in Europe. Now, what we saw is, there are kind of two things. The consumer right now is, really pushing towards services and essentials. And we're not necessarily an essentials product, but we see when we have a sale, the stuff flies off the shelves. And so we actually saw extremely high positive comp sales in all 3 regions when we had just a 7-day sale over Memorial Day weekend. So May comped up, tremendously, and then of course you have the the typical hangover in June from the big sale. So, what we're seeing right now is traffic is there, but conversion moves up and down with whether we're on sale or not. And to your point, we were on sale last year, I think. It was about 118 days during the year. And this year, we're coming up on September. September, we're on sale almost for the entire month. We'll run a Labor Day sale. We'll be in, we'll be out. And I think that's the goal, is to really push towards profitability and not push towards revenue growth.
Thank you.
As a reminder, it is star one to ask a question. Our next question comes from the line of J.P. Willem with Roth MKM. Please proceed with your question.
Hi, guys. Appreciate you taking my question. If we could maybe start just in terms of the licensing business and the joint venture, you made a call out just about kind of some of the geopolitical situation. I'm curious if there's been any kind of changes to what the JV looks like and or is going to be able to achieve relative to when you first got into that.
Thanks, JP. It's Ben Cohen. We just had a call with our partners last night. I think that, the business plan that we set out with them and really crafted, last year was to create and take back these flagship stores on Tmall, Douyin, and the platforms so that we could control the sale process, obviously not controlling inventory or manufacturing, but really control the sale process with the consumer. It's something that, the platforms wanted, and the business models in China have changed. The specific issues in China, and Chris Riley, our GC, and myself were just there 2 weeks ago, really relate to macroeconomic issues. So the economy is very, very poor in China. Outside of the luxury consumer, it's not good on the ground there. And then on top of that, moving money out of China right now, it's just a much more laborious process than it was historically, where banks sometimes are rejecting wires going out because they are leaving the mainland. Even moving money to Hong Kong at times can be challenging. And so the overall opportunity and what the business plan has not changed. It's just that the timing of things, you have to be flexible with what's going on the ground there. I think that, it's been reported by others, it's not us, that, the economic rebound people were expecting in China, post the 3 years of lockdowns they had, did not happen. And I think the consumer over there is wary right now. And so it actually helps us to some extent as we're talking and negotiating with our partners to take back some of these stores, and that's what we're focused on.
Great. Really appreciate the color there. And then one more, if I could just follow up. In terms of gross margin, obviously kind of a lot of moving parts in the P&L this quarter with the move to discontinued ops. But just curious, now that we kind of have a lot of high margin licensing rev, and then kind of also Honey Birdette as a big contributor, is 2Q's gross margin somewhat indicative of kind of the base business going forward of how that should look, or is there anything just to point out that would mislead us about Q2?
Yeah, this is Mark. It did tick up a little bit from the high margin businesses. Yeah, that's true. The one thing I would look at is the licensing business, that you'll probably see that tick down a little bit because we did have a pickup from a reversal of a commission that we had in there. So licensing will come down a little bit, but to your point, you will see HB start to lift. And so I think if you net the two together, they should be roughly about the same.
Got it. Very helpful. Appreciate the help and best of luck.
Our next question comes from the line of Greg Pendy with Chardan. Please proceed with your question.
Hey guys, thanks for taking my question. Just then I think earlier you kind of gave us the revenue dependence of the top 10 performers on Centerfolds. Just kind of wondering, could you share any color on how many of those performers are exclusive to the platform, and kind of how you're kind of thinking about that dependence going forward?
Sure. Thanks, Greg. So we don't have exclusivity with any of our creators. Our creators are free to do whatever they want, and I think that's consistent with the with the creator economy, right? They want to be able to monetize where they want to monetize. What I would say, and again, largely, once a creator has an audience on the platform, that audience tends to stay with that creator on the platform, and I don't see most of our creators on other platforms. We've actually been successful during the quarter, actually with creators that have wanted to leave other platforms, starting to move over to us, and those revenues continue to build. When I look at the concentration risk, what's encouraging to me is, our GMV is if you annualized our weekly basis, is now in excess of $35 million. And when I look at what our top 10 creators contribute versus where they were a few months ago as a percentage, that number continues to come down, because we've added so many other creators now that are earning. And so from a diversification point, where when we first started, you might have revenue concentration issues. Today, on that platform, not in the company as a whole, today you really don't have that. And so what it leads to is a much more consistent daily growth on the platform than if one of the creators historically was on vacation or sick or something. You could have seen more daily or hourly variability than what you're seeing today. And so this to me is what we've been focused on, which is really building out that middle of the platform and the health on it. And I'm encouraged. We made this change in the beginning of July. It's something that was months in the making, and very encouraged by the results. It also allows us to reprioritize the human capital internally, really now starting to focus on platform marketing. Again, we haven't spent $1 so far really of CAC against this. All of the customers have come through the creators, but it allows us to think more about the Playboy lifestyle, and marketing in very smart ways the platform versus what I would say is a very labor-intensive individual creator recruitment, just given how we were set up internally from a tech perspective.
That's very helpful. Thanks a lot.
There are no further questions in the queue. I'd like to hand the call back to Ben Cohen for closing remarks.
Thank you, operator. I appreciate everyone joining, and we look forward to talking to you on our next quarterly earnings call. Thank you.
Ladies and gentlemen, this does conclude today's teleconference. Thank you for your participation. You may disconnect your lines at this time, and have a wonderful day.